Hey, Jason here. Today's video, we're going to do the second part. We're going to do the full preliminary analysis of Turtle Beach, stock ticker HEAR. You see that on the right side of the screen, the actual analysis worksheet. But before we get to that, though, I need to let you know you can get this series as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You can get this part of the I Love Valuations podcast anywhere in the world for free. And if you like this video here on YouTube and our other videos, make sure to subscribe and hit the notification bell so you're notified every time we release a video, and release videos all the time. Okay, minor disclaimer here. Not like the long ones on the initial analysis videos, but still minor disclaimer. This is for informational purposes only. This is to show you how to evaluate stocks fast based on my processes. Do your own research. This is just what I see, and I'm teaching, or I'm showing you this to show you how to evaluate stocks better and faster. Again, I don't want to do any of these disclaimers, but I have to, because every time I do, or every time I don't, I get nasty comments. Okay, so let's get to the analysis. Okay, test. There we go. Okay, so here we are, Turtle Beach. If you want to see the part 1 of the Turtle Beach analysis, it will be in the description below. If you want to see further descriptions on some of the terms and terminology and some of the specifics in the full preliminary analysis we're doing, make sure to check out our other full preliminary analysis videos, because I've covered some of this stuff in other videos, but I'm not going to spend a ton of time talking about it here, if I have covered it in other videos. So make sure to check those out. Again, all this can be found free at the links below. Okay, I have not done anything here other than update this. This is from a prior analysis. So $461.4 million market cap. They do not pay a dividend. The reason we're doing this second stage of the analysis, by the way, if you haven't seen the first video yet, is because Turtle Beach looked like a good potential investment on our first stage analysis. Oops. Okay. Operating profit 13.7. 5-year average is plus 3.6 plus 18.8 plus 4.4 plus 13.7 equals. Also a reminder, I'm going to be calculating some of the numbers out, and I'm showing both screens. So if you're listening to this on the podcast, it'd probably be better in these kind of episodes to actually watch the YouTube video as well. Okay, so for the 5-year average at operating margin at 6.5% compared to the trailing 12-month operating margin of 13.7%, I want to know what's going to continue. Is the 6.5% going to continue going forward? Is it going to be closer to 13.7%? Is it going to be somewhere in the middle? Is it going to be somewhere outside of these ranges? I want to kind of figure that out, and the way we figure that out is by reading their financial statements, which if this surpasses our this stage of the analysis, then we will move to that second stage, or to that third stage, sorry. But that is something I would want to figure out in looking at the annual reports, which we will note down over here. Okay, share count has rose from 1 million shares in 2011 to 18 million. That is a gigantic rise of what, 1,700%? Oops. Yes, 1,700% in the last decade. That is not good. Huge share dilution is a problem, especially for smaller companies. The reason being is because over the long term, companies are valued based on the cash flows and profits they produce at a macro level. At a micro level, That means they are also valued on the profits and cash flows they produce on a per share basis. When share count increases, so I'm getting a ton of notifications from my team right now. Sorry about all the notifications. Forgot to silence my phone before I started making this. What that means is that all else remaining equal, and yes, that doesn't happen in a real world sense, but just in this example, all else remaining equal, their per share value is 1,700% less now than it was in 2011. Think of share dilution like this, issuing shares, especially this massive amount of shares, kind of like inflation, what we're dealing with right now in the US. To illustrate that, I'm going to assume that their stock chart has, in the last decade, has gone down pretty significantly, and it has. Not since 2011. They're actually up since 2011, but since 2013, let's go to that date. 2013, what date is that? February. Okay. Did I not pick the date? Okay. So the stock is down 39% from February. Let's go to March. Down 64%. Again, why? Video game and Turtle Beach peripherals are being used on more and more video games, tablets, etc. For those again who missed the first video, they make products and accessories, things like keyboards, headsets, stuff like that, other peripherals for video games, tablets, and other stuff. Now I think they also do computers now as well. This is all skyrocketing and going straight up. The demand, the supply for this, or the demand for video games and these kind of peripherals is going straight up, especially with the rise of internet gaming and playing with others. So why is their stock price down so much in this time? Large part is because of this share dilution. Share dilution is so dangerous for smaller companies that we've done case studies. And again, I can't remember the exact ticker, but I remember we did a case study where there was so much share dilution that their stock price had created about 99% in the last decade. This is why share count is so important, especially for smaller companies, because again, over the long term, companies are valued based on the cash flows and profits they produce. When you increase the amount of shares outstanding, that means there are more shares to spread out the cash flows and the profits per share, which means the per share value of the company goes down over time because the profits and cash flows are lower on a per share basis, even if they remain the same. This is why share dilution you need to watch, especially for smaller companies. Okay, book value per share fell from $12.17 per share in 2014 to $8.32 in the trailing 12-month period, or a fall of that's a fall of 31.6% in the last decade. Again, book value per share doesn't mean a huge amount anymore as much as it used to, but it still is a basic measure of a company's underlying intrinsic value. When this goes up, it generally means the company's underlying intrinsic value goes up over time. When this goes down, it generally means the company's underlying intrinsic value goes down over time. Again, this is also affected because it's on a per share basis by the number of shares. So share dilution doesn't just affect the actual per share price and cash flows. It also affects the underlying intrinsic value because on a per share basis, the value goes down. Again, I would assume some of this book value per share fall is due to the share dilution. There also may be impairments, asset sales, stuff like that, but the share dilution is definitely one reason this happened. Okay, I respond to my team real quick, see what all those messages were about. Okay, ROIC is 44.3% in the trailing 12-month period. 5-year average is, they don't have a number at all in 2017, which is confusing. Don't know why. I'm scrolling back up to see. I don't know why. So this is going to skew their average a lot. Frankly, so is 2016, where they're negative 94.4% ROIC. I'll illustrate that in a second, what that means. Okay, even with with the zero from 2017 and the huge negative number in 2016, they're still positive 3.2% in the 5-year average. Again, is the 44.3% going to continue? Is the 13.2% going to continue? Which of these is more likely to continue? Because frankly, a company with a 44.3% ROIC is valued far higher than a company with 13.2%. I look for anything above 10% on a consistent basis. So ROIC meets that threshold. Same thing on operating margin. It does not surpass that threshold at 6.5%. But again, a company with 44.3 ROIC is going to be valued higher than a company with 13.2%. Why? Because the illustration of this is for every $1 in sales the company has, this company earns 44.3 cents in ROIC in the trailing 12-month period. Over the 5-year average, that means they earn 13.2%, 13.2 cents for every $1 in sales they have. This is another proxy for profit. This is a way to measure profitability. So that's why a company would be valued far higher if they have a 44.3% ROIC compared to a 13.2. So to illustrate this, in 2016, their huge negative ROIC, this means for every $1 in sales they had, they lost 94.4 cents. In other words, that means for every $1 to earn $1 in sales, they had to spend almost $2 to earn $1 in sales. That is not good. Again, they fixed that before 2016, before 2017. They had a huge negative ROIC. So I'm guessing they had some kind of major fix in 2016, 2017 time period by looking at the numbers here. Because since then their ROICs have been fantastic. So I'm assuming there's been some kind of fix, asset sale, asset purchase, CEO change, executive change, board of directors, something major happened in 2016, 2017 for Turtle Beach to massively improve the numbers. Okay. Okay, now I'm going to silence my phone again because I keep getting messages. Apologize for that. ROE 43.44% rounded up, and 5-year average ROE is 1 plus 35.6 plus 511 rounded up minus 484.9 equals 20.21% rounded up. Okay, we've talked about ROE a couple times in various videos. I'm not going to illustrate it here again, though, because it's so important. I don't care about ROE at all, frankly. The only reason it's here is to compare to ROIC. That's the only reason it's here. Why? Because when ROE is higher than ROIC, it means the company has debt. In this case, it means the company used to have a lot of debt. In this case, the illustration of this is ROIC was negative 94.4% in 2016, while the ROE was negative 485% rounded up. That means back then the company had an enormous amount of debt because ROE is levered by debt while ROIC is not. This shows the enormous power, in this case, the negative power of having a ton of debt, because when you have a ton of debt, it multiplies your losses when it comes to ROE. In the case of almost 5x worse ROIC or ROE compared to ROIC in 2016. This also shows that now Turtle Beach does not have either any or very minimal amounts of debt. Frankly, I don't know why this happens on Morningstar's data. When ROE is lower than ROIC, it, in my opinion, should always be either the same or higher because it's levered by debt. So I don't know why. I don't know if it's because they have more cash than debt, but you'll only see this every once in a while, so I don't think that's it. But this does show that Turtle Beach does have either low or minimal debt now compared to back in 2016 when they had an enormous amount of debt. So 6% rounded up. Plus 16 plus 12.9 minus 0.7 minus 2.9 divided by 5. So this is 7.6% rounded up. This is frankly a little bit interesting. The free cash flow to sales is actually higher on the 5-year average than it was, or than it is in the trailing 12-month period, while their other margins are higher now than they are in the 5-year period. I'm assuming their free cash flow to sales is higher because they issued more debt in the past. And that's based on what we saw up here with the ROE and the ROIC. But we'll see that, we won't see that in this analysis. But that is something to think about and kind of note. Again, we'll take more notes over here on things to look at in the annual reports when we get to that stage. Okay. Cash conversion cycle has fallen drastically from 638 days in 2012 to 55 days in the TTM period. This is a fall of 638 minus 55 divided by 638 of 91.4%. Last 2012, 9 years? This is one of the largest falls I've ever seen in cash conversion cycle. Actually, on top of my head, this is the farthest fall I can remember. They have improved pretty much across the board. Day sales outstanding is down from 62 days rounded up to 29 days in the trailing 12-month period. Days inventory is down from almost 1,100 days in 2012 to 89 days. Payables period is down from 513 days in 2012 to 63 days. Back earlier in the decade, I can now tell you why they were having major problems because they weren't selling stuff fast enough, which increased their inventory to a frankly insane level. 1,100 days, or 1,089 days, that's what, 2.5 years, 3 years, something like that, of inventory. That is absurd. That's why their margins were so terrible earlier in the decade, and that's why their margins have improved so drastically, or these are huge reasons why their margins have improved so drastically in the last decades, because they've gotten a better control of their sales cycle, their inventory, and they're also paying stuff faster. They're paying their suppliers faster. They're a far more efficient company now than they were earlier in the decade, and this leads to higher profits, profit margins, and those kind of things. Typically, it's to higher values too, although again, share dilution kind of offsets that in this case. But that is a very good thing. I'm sorry, I'm getting my... Okay, again, apologize for that. Don't usually get a ton of messages like this. Okay, so far, company looks okay. Not as good as it did on first analysis. The big reason why is, frankly, this share dilution here, and also the questions raised with the book value per share, the operating margins, and will these trends continue, frankly? Will these trends of efficiency and increased profitability continue? I would expect they would, but we need to find that out for sure in the analysis. Now we're going to get to some relative valuations down here and earnings yields, because frankly, especially the valuations, is where most companies go to die for me. Okay, so 461.4 minus cash, need the balance sheet for that. Where is, there we go. Okay, 56.2 in cash and short-term investments, debt. Oops. Current debt, total debt and capital lease obligations, they have 0. That is fantastic. Long-term debt, they have, again, 0. They have no preferred stock, I already see. Minority interest, and again, I'm going to scroll up and down to see, but I would assume they don't have any minority interest. Most smaller companies do not. Okay. And I do not see any minority interest either. So let's calculate this out. Minus 56.2 plus 0 plus 0 plus 0 across the board. 2. Okay. What this means, or what this shows right here, is this is one sign that its enterprise value is lower than its market cap at 461 million. That's one sign the company might be undervalued. Why? Because from this analysis, we see that the company has more cash, or a ton of cash, compared to their debt levels. In fact, 56.2 million in cash equivalents, and short-term investments, compared to 0 short-term debt and long-term debt and capital leases. What that means is, again, as enterprise value shows us what we'd have to pay for the company if we were to buy the entire thing today. That's how I think as an entire business owner. I want to know this number because since 99% of all companies on earth have either cash or debt or both, I would want to know that as a business owner. And typically cash is taken out of a purchase price. So that's why the real purchase price, or quote unquote real purchase price, is closer to 405 million. That's why this is one sign that the company might be undervalued. We will go to other signs here. This also shows that the company has more cash than debt. Again, 0 debt in this case. That adds more margin of safety to this investment as well. Operating income, so 57. Free cash flow is 25. 61.4. So 8.09 divided by 25. So 18.5. So I look for anything on these metrics, EV to EBIT and EV to free cash flow, of below 8 to show the company's undervalued. EV to EBIT is 8.09. EV to free cash flow is 18.5. But these show that the company is overvalued. On these two metrics, these are called relative valuations. So we just value the company 2 separate ways, actually 3, including enterprise value. This is another valuation down here. Why does this mean the company is overvalued? That's why I have the earnings yields down here, which is just the inverse of the 2 numbers I just talked about. 461.4 is 12.4%, and 4 divided by 25. Oops. Did the wrong thing. 25 divided by 461.4 equals 5.4%. This is why this illustrates this company is overvalued. On this metric, on earnings yield, this shows you simply what, if you were buying the company today based on the currently available information, the information we just went through above, to calculate enterprise value compared to EBIT and free cash flow, what you should expect to earn owning this stock if you were to buy it today. Now, this never works out to these exact numbers, but 12.4% return, that's pretty good. I look for anything above 10% on this number. 5.4% is frankly, that's the rate of inflation right now. So including the rate of inflation, that means if you bought this stock today, you would earn 0%, or you should expect to earn 0%. It's actually lower than that because of taxes and fees as well. But so that is why this illustrates that this company is overvalued, because 5.4% return right now, again, is not good because of the rate of inflation, taxes, fees, all those kind of things. Typically, the higher this number, actually pretty much always the higher this number is, the better, because it means it's more potentially undervalued. So what this means here is that I'm going to put the following note. Didn't do below because I'm not surpassing enough of my criteria above. So I put that note here, didn't do below calculations, which you're seeing over here, and notes and basic valuations, ROIC calculations, notes to look for in annual reports, stuff like that, because it didn't surpass enough of my criteria above. Its operating profit margins over the 5-year average do not surpass my thresholds. Its share dilution is a massive issue, especially because it's a smaller company. Book value per share is going down. ROIC is good. Free cash flow to sales, again, some of this is good, about half is good, half is not great. And when I say it's not great, it doesn't mean it's bad stock. It doesn't mean it's a bad company. It just means it doesn't surpass my thresholds. This entire worksheet we just did is to find great companies, great potential investments that are undervalued as well. If the company was undervalued over here, I would probably keep researching it, but because it's not, even though it's kind of half and half above that, because it's not, because it's overvalued though, I'm not going to continue researching it. But so this is the end of the analysis on Turtle Beach. We will continue our analysis on other companies like WidePoint, Perdocio, Ternium. We're still analyzing those companies, and we're still analyzing more stocks, frankly, on an everyday basis from viewers who request these on YouTube. But I hope this was helpful. If I missed something, if I should explain something better, if I didn't explain something well enough, let me know in the comments below. If you're watching on YouTube, thanks so much. We really appreciate it. We'd also really appreciate like, love, share, subscribe, comment, all that good stuff. And we'd also appreciate, or if you do subscribe on YouTube, make sure to hit the notification bell, because we're so you're notified every time we release a new video, and release new videos all the time. You'll also be notified when we do lives, and we do lives typically every Wednesday. Although this week, today's Wednesday, we're not doing one today because of some scheduling conflicts, but you'll be notified anytime we do a live as well. If you're listening on the podcast, again, thanks so much. Really appreciate all the same stuff. And on the podcast, we'd also really appreciate a review, because the more reviews, views, and listens we get on our content, the more people we can help. If you're looking for more specific help to become a better investor faster, make sure to check out our free resources below, including our 5 free gifts, where you can get this entire worksheet, and I'm pointing to on my other screen that we just did. You can get that for free as part of the 5 free gifts, so you can analyze stocks well and fast as well. And again, we are at about 30 minutes, just under 30 minutes, and we've already done the analysis. We get really good at this worksheet. You can do it 15, 20 minutes. It took me a little bit longer because I was explaining stuff, but this worksheet will help you evaluate stocks better and faster than most professionals on earth. That's how in-depth and well this worksheet is put together, and everything is in there for a reason, as we talked about in this video and the other videos. So you can get that as part of the 5 free gifts for free. You can also get a free PDF copy of my book, How to Value Invest. You can also get a free guide, 7 tips to picking great stocks and 3 times you must sell, for free at the links below as well. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out our newly relaunched masterclass. We're giving away $9,000 in free bonuses, including free one-on-one sessions with me, including something we call the Value Investing Blueprint. That is the exact entire step-by-step process, including pictures, including 28 video resources, including exact URLs where I look for stocks, how to find, evaluate, and value stocks fast. We're giving those two bonuses, the Value Investing Blueprint and the free one-on-one sessions with me. We're giving those free to the first 10 people that sign up. We've already got 2 people signed up as of this recording. Got another 2 potentially coming in. And so if you want those bonuses, make sure to go to get our masterclass today. But until next time, have a great day. Talk soon.